Now we'll see illustrations on all these rules that we have seen, 40, then 42, 43, 44. Okay, so let's start with 40. And questions will come like this in the exam. In May 18 also a question came directly from these illustrations. Almost 99% was the same with minor changes. Akshat Steels Limited is a manufacturer of iron and steel. Very good. He procures raw materials and inputs such as iron ore, chemicals, gases, etc. and capital goods including plant and machinery for the manufacture of such iron and steel. Excellent. In this example, it has been assumed that iron and steel, which is an outward supply of Akshat Steels Limited, is exempt from tax. Okay, so your output was exempt until 31st March 2020. Till 31st March 20 it was exempt. Iron and steel becomes taxable with effect from 1st of April 2020. So you can understand the question is based upon the initial credit. The initial credit that you have to take on the stock of inputs as it is, stock of inputs in semi-finished goods and stock of inputs in finished goods stock as on 31st March 2020. So we'll calculate three things. Inputs as it is, as such, inputs in WIP, that is semi-finished, and inputs contained in the finished goods stock which is held by us on 31st March 2020. And we'll see what was the GST paid on these input stock and then take appropriate credit. So CGST if paid, that will go as CGST credit. CGST, SGST will go as SGST credit. I integrated goods and service tax, IGST will go as IGST credit. Okay, so you have to maintain separate accounts for each type of tax, CGST, SGST or UTGST and IGST. Okay, so that we'll see in this example. Those points will get cleared. Okay, and also the capital goods will also take credit of capital goods. Now in capital goods what we'll do is we will see how much GST was paid when it was bought, and we will see how many quarters have already gone from the date of invoice up to 31st March 20, and for those many quarters we will deduct 5% per quarter. After deducting that 5% per quarter, whatever is left will be taken as credit. Okay, so that example is given here. Very simple calculation, 5 to 6 marks question straight away in your pocket. So let's see. The method of availment of input tax credit on inputs contained in stock and so on and so forth is covered by this illustration. Very good. So first thing given is value of inputs in stock. So this is inputs as such, as it is in stock on 31st March 20, 1 lakh, on which there is IGST paid at 18%, that is 18,000. So this will be taken as IGST credit. Okay, 18,000. But an important point is given there. All these inputs were procured after 1st July 19. Now this statement is very important because in Rule 40 we had seen that the invoice should be 1 year old maximum. If it is more than 1 year old, then you cannot take the credit. So credit can be taken only on the basis of invoice which is in between the last 1 year. So we are calculating the stock on 31st of March 2020, right? So the invoice should be anytime dated on or after 1/4/19. So we need an invoice anytime issued after 1/4/19 with effect from 1/4/19, you can say. Now this says that invoice is issued after 1st July 19, so that's good. So July 19 will fall within the last 1 year, so that's good. We can take credit. Next, value of inputs contained in semi-finished goods held in stock on 31st March 20. So value is also given. Now value we don't need actually, but it's given, so good. We need CGST, SGST. Now in this case there is CGST and SGST. So this might be the local purchase, intra-state purchase, 24,000. And all inputs contained in semi-finished goods were procured after 1st May 19. So that is also within 1 year. That is also within 1 year. So good enough. So we can take credit of these two also. Okay. Then value of inputs contained in finished goods held in stock on 31st March 20. Now we have seen finished goods. Inputs contained in finished goods. CGST, SGST is given 66%, 33,000. But only inputs worth 40,000 out of 50. Out of 50, this is related to this. So goods inputs worth 40,000 in finished goods were procured after 1st April 19. Means 10,000 were procured before 1st April 19. So will you get credit on that 10,000? No, you will not get credit. So 10,000 would be disallowed. Tax on 10,000, no ITC. So let's calculate the proportionate amount. So on 40,000 it will be allowed because the invoice is after 1st April 19, that is within the last 1 year. So tax is at 6%. So how much will be 6% of 40,000? 2,400. So ITC claim will be only 2,400 for CGST and similarly for SGST. Understood? Got this point? So all these things you have to calculate in the working notes and they are given there in the example. I am explaining the concepts. Okay, so got this concept? Very good. So credit available in respect of inputs will be CGST 26,400. 26,400 means 24,000 plus this 2,400. Similarly SGST 24,000, that was on semi-finished, plus 2,400, and IGST was 18,000, the first one. Simple calculations. So total credit available will be 70,800. Now value of capital goods used exclusively in relation to exempted goods held on 31st March 19. Let's talk about capital goods now. So you have capital goods also, which was exclusively used for exempt manufacture earlier on. 20 lakh was the cost and IGST was at the rate of 18%, that is 3,60,000. Very good. Credit available in respect of capital goods will be date of invoice. Now this is important. Date of invoice of the capital goods was 22nd January 20. So how we'll have to calculate the quarter. So 22nd January 20 to 31st March 20. This makes it only 1 quarter, right? This falls within 1 quarter. So what you have to do is very simple. You have got 3,60,000 IGST. So you take this and you reduce 5% from there. So 1 quarter you have to deduct 5%. So 3,60,000 into 5% will be 18,000. So you deduct 18,000. After deducting you will get 3,42,000. So 342 will be the credit available. Simple calculation. So see, that is given there. You have got 1 quarter of use and therefore 360 minus 18 will be 3,42,000 credit available. And then all the working notes are given there. That is for you to read. Value of inputs. CGST credit. So first is CGST credit. So in case of CGST, on inputs there is nothing, so there is nil. Then in semi-finished you have got 24,000 and in finished goods you have got 2,400. That is proportionate, considering the invoices which have been issued within the last 1 year, that is of 40,000. So this is 40,000 into 6%. So total 26,400. Similarly, SGST on the same lines, nil, 24,000 and 2,400. And IGST you have got that 18,000. Okay. So then come down to illustration number 2. Rule 42. This is an interesting one. That is, when you manufacture, you can write down over that. This is in respect of a person who utilizes the inputs for non-business purpose as well as for the exempt supplies as well as for the taxable supplies. So when you use the inputs for non-business purpose as well as for making some exempt supplies as well as for making taxable supplies, then how much credit is to be given and how much is to be disallowed. Let's see. So this we had seen there, all those T's, T1, T2, T3, T4, and then common divided in the proportion of E upon F, right? So that is the point. Very simple calculation. Let's see. Firstly, it is given total input tax on inputs and input services for the tax period May 2018. So this calculation is to be done for every month first, and then at the end of the year you do annual calculation. Okay, but here the example is given for 1 month only. That's good. So for May 18, this is T, the total input tax. CGST you have got 1 lakh, SGST 1 lakh, and IGST 50,000. Because calculations are done separately for each type of tax. Okay. Out of the total input tax, now let's see. Out of this, so all these figures are out of 1 lakh. So this is the total. Now out of this, input tax used exclusively for non-business purpose. I mean to say input tax relating to inputs used for non-business purpose. So I have shortened the sentence. Input tax in respect of inputs which are used exclusively for non-business purpose. So this is called as T1. Will you get credit of this? No, no credit. So just write down here, no ITC. We will not even take credit. Similarly, next one, input tax used exclusively for affecting exempt supplies. T2. Will you get credit? No. No ITC. Then in the third step you have got input tax ineligible, means the blocked credits. So this is the blocked items. Roshagulla's blocked item. So no credit again. This is called as T3. No ITC. So how much is the total of this? Just calculate 25,000. 25,000 and 12,500. So no credit will be allowed in respect of these 3 items. Oh, it's already given, sorry. Then the balance calculation. So balance, if you deduct these 3, the balance is 75, 75 and 37,500. These 3 will be credited to electronic credit ledger, means ITC taken. Okay, these 3 you will credit to your electronic credit ledger, means you will avail the ITC. Then out of this we'll see what are the inputs which have been used specifically, exclusively for taxable supplies. That is called as T4, exclusively for taxable supplies, including the zero rated supplies. So that is T4, and these 3 items are actually full credit items. You will get full ITC, means there is no reversal in this. So out of 75, 75 and 37,500 you deduct this. This is fully credit taken. So the balance now will be 25, 25 and 12,500. So this will be called as a common credit. This is in respect of those inputs which have been used commonly for all the three. Okay, so this is now called as the common credit. Now in this common credit we'll do two reversals. One for exempt supplies, that will be E upon F, exempt turnover divided by total turnover, and one for non-business use, that will be ad hoc 5% of 25, 25, 12,500. So one is that for non-business purpose we'll take 5% of this, and for exempt supplies we'll take E upon F. So we need to know what is E and what is F. So E is the turnover of exempt supplies, F is total turnover. So that is given here E and F. 25 lakh upon 1 crore. So total turnover was 1 crore in the month of May, out of which 25 lakhs is exempt. Means how much? If you calculate percentage wise, it is 25%. Similarly here 25%, and similarly here 25%. Obviously it will remain same. Exempt turnover upon total turnover has to remain same. It doesn't differ for different types of tax. This is business turnover, so that will remain same. Means 25% of my total turnover is exempt supplies. So what I need to do? I need to reverse 25, 25, 25% respectively of these figures. So calculate 25,000 into 25%, 6,250. See, it's simple. You follow the logic, don't follow the formulas. Formulas can be forgotten. Logic always stays with you. So 25% is my exempt turnover. So I need to reverse 25% of 25,000, 6,250. Similarly 25% of 25,000, 6,250, and 3,125. So this is in respect of exempt supplies. Then I have to also reverse that 5% ad hoc for non-business use. So for non-business use, assuming that these have been put for non-business use also, 1250 5%, 1250 625. Now take total of this. I think it's given. Yeah. It's not given. So first you take the total of this. This is the total reversal. So this is 7,500 total reversal. This again 7,500, and this will be 3,750. So these figures will be reversed out of 25, 25 and 12,500. So if you deduct these, this is reversal, credit reversal. Okay. So if I reverse this, then it will give me the net credit will be 17,500, 17,500 and 8,750. Okay. So this is common credit, eligible common credit. And then if I add that T4 to full credit, that will give me 67,500, 67,500, 33,750. Okay. And what do you have to do about this? The actual procedure would be that first I will take credit here. This is ITC availed 75,000, 75,000, 37,500. Out of this, we have to reverse this much. So this amounts 7,500, 7,500 and 3,750 are added to output tax liability and reverse. Reverse means debited to electronic credit ledger, and if you don't have balance in electronic credit ledger, then they will be debited to electronic cash ledger. Okay. So this calculation will come for around 6-7 marks. Great. You can read the working notes. Just to understand how to write working notes. Now, next we'll go to Rule 43 illustration. Now this is regarding the capital goods. Okay. capital goods which are partly used for exempt supplies, taxable supplies, and the non-business use. Okay, so let's see. First point given, ITC on capital goods used exclusively for non-business purpose. Will you get credit of this? No. No ITC. Okay. Then ITC on capital goods used exclusively for affecting exempt supplies. Will you get credit of this? Again, no. No ITC. Now, it says ITC, it means input tax. Okay. Deduct the word C there. Input tax on capital goods used exclusively for non-business purpose. You will not take ITC. Then input tax on capital goods used exclusively for exempt supplies. No ITC. Total 20,000. Then ITC on capital goods used exclusively for taxable supplies including zero rated supplies. Here you will get full credit. Full ITC allowed. Okay. Then ITC on capital goods other than T1, T2 and T3. Other than T1, T2 and T3 means common. Common use. That is 3,90,000. Now what you do is ITC on capital goods whose residual life remain at the beginning of tax period. Now actually this is example form, so if question comes then all these figures will be given as question and then you have to write this answer. So we are directly reading the answer. So therefore you may not understand, but when you read twice or thrice you will understand the points. So ITC on capital goods whose residual life remains at the beginning of tax period means our tax period is, say for example, whatever we take, if we take it as May 2019 or 20, whatever you want to take, then that means that the 5 years period have not expired. 5 years period have not expired. So that is 6,500. Now how this calculation is done, 6,500, I'll tell you. Come down to annexure A. Here you will understand that. It's given ITC on capital goods whose residual life remains. One is inward supplies of machinery X 12,50,000. GST paid thereon was 1,50,000 at the rate of 12%. Okay. Total invoice value was 14 lakh. Okay, here it is given for May 18. That's good. Date of inward supply was April 2018. Okay, so this capital asset has not been purchased in May. Our current period is May 18, for example, but this asset was purchased last month. So when it came last month, we'll have to divide it by 60 months. The expected life is considered as 60 months. So if you divide it by 60, it will give us how much? See, it is taken residual life 60, and if you divide it by 60, it will give you 2,500 per month. Okay. So this is with respect of the asset which had been acquired in the previous periods. Now, it can be last month, it can be 10 months before, it can be 25 months before, it can be 36 months before. Any asset that has been acquired within the last 60 months will come here. Anything which has been acquired in the last 60 months, that is the 60 months period have not expired, so that will come here. Aggregate of all those assets. In this example it is one asset, then you can have multiple assets, so that will come here. And the current period, the asset which has been acquired in the current period. So inward supply of value of machinery Y, this is in the current period, May 2018. 20 lakhs, IGST 2,40,000, total invoice price. Date of inward supply C, 21st May 2018. So this also you will divide over 60 months. This is the first month. So again, if we divide 2,40,000 by 60 divided by 60, it will give us 4,000 per month. So this 2,500 which is brought forward from earlier periods and 4,000 of the current period, total will give us 6,500. So this is per month. Now out of this we have to reverse E upon F. So you have to reverse. So in capital goods what we do is, when the capital goods come, we take full ITC. We take full ITC. Then if it is exclusively for manufacture or supply of taxable goods, then no problem. You take it, you have it, you use it. But if the capital goods have been used for common exempt and taxable supplies, then first you take full credit. You take full credit, and then over the next 60 months you have to reverse the credits. Remember, we had seen this one. You have to reverse credit in the ratio of E upon F. Exempt supplies, turnover of exempt supplies divided by total supply. So every month we'll have to reverse. So we divide this credit over 60 months and then keep reversing every month. E upon F, E upon F, E upon F, E upon F. Okay. So this 6,500 is with respect to these capital goods which are commonly used. So now we'll reverse. So reversal will be, come back, the figures are given, exempt supplies and taxables, total turnover. So E is turnover of exempt supplies, F is total turnover. 25 upon 1 lakh means again 25%. So what you do, you have to reverse 25% of 6,500. So let's do it. 6,500 into 25%, 1625. So 1625 will be reversal added to output tax liability. Okay, it will be added to output tax liability. Then comes rule 44. 44 is the reverse thing. That is, we are moving from taxable to composition scheme or taxable to exempt scheme. Then how do we have to reverse the credit? Let's see. This is given illustration 1. Value of capital goes 1 lakh. IGST paid on that was 12,000. Invoice value 1,12,000. Okay. Date of shift to composition scheme 1st April 2019. Date of inward supply of use of capital goods 1st September 17. So this capital goods was acquired on 1st September 17. So what you have to do is calculate the months of use already used and the balance. So we take total 60 months as the life of the asset. Now you see how many months it has already been used. So if you calculate the actual period in days, it comes to 577. In months it comes down to 19. Out of 60, 19 months has been used, so 41 is the balance. Residual month is 41. This is what we have to reverse. So it is a simple formula. 12,000, that was a credit taken, divide by 60 multiplied by 41. Okay, the formula is not written there, but you can write it there. 12,000 was the credit availed initially because we were into taxable scheme. 12,000 into 41 upon 60. 12,000 into 41 divided by 60 is equal to 8,200. So that 8,200 is given here. ITC for residual life 8,200. Then there are two examples given there. Now what I have to do is I have to reverse this. So reversal means you have to debit it to electronic credit ledger. Okay. So this is debited to electronic credit ledger provided there is balance there. So therefore we have taken two examples. If the balance in electronic credit ledger is more, say 10,000, then I will debit the whole 8,200 here. But if the balance itself is 7,000, then I can debit only 7,000 here. So in this case I am debiting full 8,200, but in this case I can debit only 7,000, and the balance 1,200 will have to be debited to electronic cash ledger. So this is cash payment. Cash payment means electronic cash ledger. And in this case, the total balance was 10,000. You have debited 8,200. So the balance which is left will lapse. The balance lapses, ends. And in that only the second illustration is given, that value of capital goods is now the tax payment was itna. Date of shifting is 1st April 23 and the purchase was in 17. So total number of months already used is 67, that is more than 60. So if you have used an asset already for 60 months and thereafter you are shifting to composition scheme or exempt, then there will be no reversal. There is no need to reverse anything because you have fully consumed your credit. So therefore no reversal.